Well, things have gone from bad to much worse. We have recently just learned that retail investors have officially capitulated over the past two trading weeks as we have seen the S&P 500 reach back to its June lows and surprisingly break below it. So I'm sure this means that the stock market is going to continue going down as retail investors panic sell all their positions that they hold in the Robinhood and TD Ameritrade accounts. Well, as we all know, it is never that simple in the stock market, and instead, this news about retail investor capitulation is actually a very good thing. And that is exactly what I want to address in this video. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, I want to actually address a tweet that came out by Ray Dalio very recently, where all of a sudden he shifted his opinion into thinking that cash is actually no longer trash. Now, the reason why this is absolutely hilarious is because Ray Dalio historically has always been a buy the dip kind of investor, and he has always positioned himself away from just holding straight cash. And well, his simple argument for that is that you get basically no return on your cash when it's just sitting in the bank, and instead, high inflation actually eats up the value of your dollar. So you're much better off investing it in the stock market or in bonds where you can get a 5 to 10% return. But when he comes out and says that his opinion for the past 20 to 30 years has been flipped upside down all of a sudden in a matter of a few months, it really goes to show you that we are living through an historic period and that we could be near the capitulation phase or the bottom of the stock market. And the reason for that is extremely simple. When you have hit peak pessimism, there is going to be nobody else left to sell your stocks. And it's typically always occurring during times when the headlines look the bleakest and when the optimism is at an all-time low. And it's safe to say that that is obviously when you get the best returns as an investor, because historically the S&P 500 has always returned fantastic after falling 20% from record highs, even though in some cases it took more than a year. And I think this graphic right here does a really great job of summarizing my point. You see, when stocks are at all-time highs and there is peak optimism and basically no fear in not only the retail investor, but also the institutions, then there is absolutely no way you're going to make money because the risk to reward is just broken in that kind of environment. Because if everybody's bullish, then who else is there left to buy? You have more downside in that kind of scenario than upside. But when the stocks are down, that's when retail investors come out and say, oh my God, everything's a scam, the market's going to go to zero, because that is what the recency bias in their heads tells them. And the reality is that these guys might have bought stocks at all-time highs and they immediately sold them for a loss, and now they want the prices to go down even lower so that the other people also lose money. And that right there is the sole reason why this chart right here exists. Retail investors and the psychology of the market is what drives investors' wealth and their destruction. When most retail investors think that we're at the complacency or the anxiety phase, that's when the bottom is going to be very close to us, because as we all know, retail investors always lose money in the long term because of their own psychological drawbacks. As a matter of fact, retail investors are actually shorting the market like crazy right now, and the bets against the S&P 500 specifically is at a peak, which we didn't even see in 2008 or even 2020. And a big reason for that is because a lot of the early millennials and Gen Z folks are seeing their bear market for the first time in their adult life. And I think that goes to show exactly why we are seeing so much volatility in this market and such an easy spread of misinformation and fear. Because let's be honest, this is the first time that social media has been mainstream during a bear market. We have not seen something like this over the past decade, and in the past decade is when we saw the adoption of consumer electronics really skyrocket. And so because of that, all the fear and pessimism inside the average retail investor's head tends to get amplified through social media, which leads to extra volatility and extra panic selling. And it leads to charts like these shared on social media, which tend to scare a lot of folks, but also fool a lot of folks that understand that the situation right now is completely and miles different from all the other charted situations on this graphic. But by far the biggest reason why I think retail investors really lose in the long term is because they think that just because their stocks have gone down in the short term right after they buy, that they made a bad decision and they decide to sell out of their position at a realized loss. And as you can clearly see, even if you see big drawdowns in the S&P 500 in the short term, even after you buy, over the next 6 to 1 year, you will still see much better returns than if you had just not sold. And the thing is that unlike real estate, which is what most Americans own, in the stock market, you get a quote of your investment every single second. And that leads to some folks who have a lot of anxiety to be completely poor investors and be very anxious about their investment at every single moment of the day. And obviously, as we know, over-analysis always leads to poor decision making, and that is the number one reason why many retail investors end up failing. But I'm sure all of you guys already know that. So why am I bringing this up on my YouTube channel today? Well, because I'm here to help the average retail investor build their conviction in their own companies and not get caught out in all the fear and FUD that has cost so many retail investors millions of dollars over the past decade. And right now, the big narrative that I'm seeing in the market that is misinformation is the idea that you don't want to fight the Fed and that until the Fed pivots, the market is going to continue going lower. And after seeing tweets like this, I simply can't hold back in addressing the massive drama we are seeing on social media around this "don't fight the Fed" narrative, which is completely and utterly overblown. First off, if you look at this chart right here, as you can see, interest rates have always gone up even when the stock market has gone up. So there is absolutely no direct correlation in what interest rates are doing and how equity prices are going to perform. And secondly, as you can see, the main point of this graphic is that the previous 6 bear markets saw bottoms only arriving when the Fed started cutting interest rates. And as you can clearly see, that is definitely true. But investors are missing a massive point. This bear market in the first place has been caused by the Fed themselves. Every single bear market that this graphic is showing us was caused by external events that were either driven by the Great Recession, the 2020 pandemic, the tech bubble, or obviously the gold standard removal in the 80s. And so right now we are going through a completely different scenario to every single one of these time frames, because right now the Fed is telling us exactly what they're looking at to judge their policy decision, which is obviously inflation. And so yes, it's true, the Fed comes in to bail out the market every time there is a crisis, but that is something you need in a healthy economic system. Otherwise, the entire market is going to collapse and the economic stability of the US is going to falter. And in this case, the economic stability of the US has been so good and prosperity has been so high over the past 2 years that that has actually caused inflation, and the Fed is purposefully stepping in to bring it down, which means this bear market is pretty much artificial. Let me say that once more for the folks in the back. This bear market is artificially driven to bring down inflation. And so if you really want to time the market by buying the bottom when the Fed pivots, then you want to pay attention to the inflation indicator. And as I've already said countless times over the past month, the leading indicators of inflation are already showing us that it is subsiding, which means that at some point the Fed might start easing interest rate hikes, and that will already result in a massive stock market rally because the market always looks ahead 6 months. It is not focusing on what's happening today, it's going to focus on what could happen in the future. And as you can see, the Fed has already tightened pretty significantly, and their QT program is already well underway. And this is again yet another thing that many people misconceive, which is the fact that QT means that the stock market is going to continue going down. Well, as any macroeconomics will tell you, that is simply not how it works. QE is essentially when the balance sheet is expanding, QT is simply when it's decreasing. And the balance sheet has two sides to it, an assets and the liabilities. And in this case, in the QT side, essentially the Fed is selling their assets and covering them with liabilities, meaning that their balance sheet will not actually shrink. And overall, as you can see in the long term, the Fed's balance sheet always goes up because of the economic growth in the country and the demand for the dollar. And as you can see, quantitative tightening is a byproduct of raising interest rates. And interest rate policy has already shown its effect on bringing down inflation, which means that the Fed has no real reason to sell all of its junk bonds, MBSs, and obviously they're very, very low grade bonds. And unlike what the consensus thinks, no, selling these bonds doesn't mean the economy is going to collapse, because these bonds are typically lent out to companies that are very young or very early stage. Those companies basically contribute nothing to the economy in the very bigger picture. The S&P 500 is literally driven by Apple, Microsoft, Amazon, and Tesla, and these companies are not issuing any junk bonds or mortgage-backed securities. The real point of QT is to deleverage the market and bring the credit cycle down from its highs. And as we know, credit cycles going down are a healthy part of a long-term sustaining economy, which is exactly why one of these times buying the dip has always historically paid off. But obviously, guys, that is just my opinion, and this is not financial advice, so let me know your thoughts down in the comment section below.